David, welcome to the show.
Thanks so much.
Glad to
Glad
have
to
you
be.
here, man. And I've already given you a little bit of a preview. This is a hard topic to make sound sexy, but this is a very important topic, right?
It is, and I do it every day, and making a lot of people money.
Yeah. Okay. Let's start at the beginning.
You
Define
got it.
for us cost segregation.
Cost segregation sounds complicated, and I know a number of years ago when I was first introduced to it, I thought, "What in the world is this?" Here's what happens when you buy commercial or rental residential property. It doesn't last forever, and so the government gives you the opportunity to depreciate part of that property every year and giving you a deduction off of your taxes. Typically, the way that it's done is for commercial property or for short term rental property, it's depreciated over 39 years. So you take 1/39th of the property, and that's how much you can deduct it from your taxes every year. Or in the case of rental residential, 27 and a half years. Where they came up with that, I have got no idea.
Yeah, I guess they're thinking the house will last 30 years. But all right. But now you're talking about the value of the improvements, not the land itself.
It's the building and the improvements, not the land.
Yeah.
What we do is we basically break that property up into all of its component pieces and parts, at least on paper, a lot of which can be depreciated according to the tax code at 5 years or 7 years or 15 years. By speeding up your depreciation, you get a bigger tax break at the beginning. Because of the CARES Act back in 2020 or 2017, the Tax Cuts and Jobs Act in 2017, all of that 5 year, 7 year, and 15-year life property till the end of this year can be deducted 100% the first year. Starting next year, it's 80%. And then each year it goes down 20% until it reaches zero, of course, unless Congress decides to change that, which they tend to do without consulting with us, but we hope they really do. And so that's cost segregation. It's breaking that building into its component pieces and parts, speeding up the depreciation, which gets you a much bigger deduction. And then because of 100% bonus depreciation, gets you a huge deduction in the first year.
Okay. Now you need to explain bonus depreciation.
Bonus depreciation is what happened in the Tax Cuts and Jobs Act, where they said any property that was purchased between, say, October of 2017 and the end of 2022, you can take 100% of all of that shorter life property, the 5 year property, the 7 year property, and the
Okay.
15-year property, 100% the first year. For
All right.
properties in 23, it'll be 80%, then 60, then 40, then 20, then zero.
Now, if you resell this property, you have to recapture everything that you've depreciated, right?
To a point, there is depreciation recapture. And so I don't recommend that anybody do a cost segregation study unless they're planning on holding the property for at least 3 years.
Okay.
By that time, some of the 5 year depreciation has taken hold, and depending on the way you structure the sale, you can still take advantage of some of that depreciation that you've taken. You will have to pay back some unless you do a 1031 exchange on the property, in which case there is no depreciation recapture.
Okay, guys, that's why I led off this show by saying this business can have some big words and some complicated ideas, and there's some complexity involved in here. You're going to need to consult with your tax advisor. You're also going to need to talk probably with our guest today, David Wiener. So, David, right now, tell us how people can reach out to you if they want to.
Best way to reach out to me is either through text at 770-367-8091, or you can just call me at my office at 770-224-8504.
What about social media?
Social media. My company is called Cashflow Strategies. You can find me at cashflowstrategies.us. You can also find me on Facebook, my name, uh, Instagram, Twitter, you name it, you'll
Okay,
find me.
so just look for
And,
David
and
Wiener.
oftentimes, if you look for Mr. Cashflow, you'll
Okay.
find me.
Yeah, look for Mr. Cashflow and you'll find him. All right. Now, do you do any courses? I probably should have asked you this before we got into this recording, but do you do any courses on the topic?
I do. I do courses for. I've done the Georgia Society of CPAs real estate conference and taught the CPAs about cost segregation. I've done webinars on it. I teach regularly at real estate conferences. If you have any real estate conferences and you need a speaker, let me know. I'd be more than happy to come and talk
Okay.
about cost segregation.
All right. Now, back to cost segregation. It's interesting to me that you teach CPAs about this. Do you get a group of CPAs in the room and they've heard of it but they don't really know how to implement it for real estate investors, or is it just
Yeah,
completely foreign to them?
no, it's not completely foreign. They know the concept, but my dad was a CPA, and he always used to tell me to be a CPA in today's world, you've got to be about 10 miles wide and a foot deep. In other words, you have to know a little bit about a whole lot of things.
Yeah.
And so I work with CPA firms all over the country who consult with me on cost segregation. Some of the real estate CPA firms, especially, just automatically send their clients to me, and we take care of it for them.
Okay. Now, this cost segregation, how legit is it really? I know it's legal, but is the practice, is there enough settled practice that's been tested in the courts that we really know what to do or what you can and cannot do?
I'll tell you a little bit about the history of cost segregation. It's been on the tax code, in the tax code since like the 1950s. But it was so unaffordable that only the wealthiest of the wealthy could afford it. Back in 1997, the IRS was after Hospital Corporation of America for about 800 million in back taxes, and they said they didn't know it because of this provision in the tax code called cost segregation. Well, the IRS, as the IRS is known to do, wouldn't give up on it. And so they wound up hiring an engineer to come in and do a full engineering based cost segregation study for them. And they took the IRS to court. They won. All of their back taxes were abated. And that same engineer is the founder of Cost Segregation Services, Inc., the company that I work with. Still the CEO and president, still signs every study. It is considered by the tax code as the certain method of depreciation. Um, I know that for sure because we've done over 30,000 studies and haven't one time triggered an audit.
Okay,
So
so let me ask you this: if you accelerate the depreciation in one segment of this property that you own, aren't you basically increasing your tax liability in future years?
maybe a little bit, because the amount that can be accelerated in a property is generally, at least in a residential property, is about 20% of the property. It's what everything that's non structural in the property. They consider that to be personal property and the structural part of the building to be real property. And so if you're accelerating 20% of it, you get this big tax break at the very beginning. You still get a depreciation expense every year after that, which is really just a little bit less than it would have been had you done it straight line. The genius of the entire thing is what they call the time value of money. And if you understand the time value of money, it becomes a big deal and to me an absolute no-brainer.
Okay, David, let's talk now about the time value of money. You kind of threw that in there, and
Okay.
I don't know if we're going to whip out our financial calculators now and do some. No, let's not. Um,
No, we won't get technical about it.
all right.
Just the
So,
idea is you rather have it now.
yeah, yeah, you'd rather have the money now, and
And you can put it to work.
I guess kick the can down the road. All right. Now, the other thing that I was thinking before we went to the break is this sounds like something that big institutional investors can do. How do I know if my properties are really eligible? I'm thinking maybe for a single family, this isn't even going to work.
Actually, it will.
Okay.
Used to be that cost segregation companies wouldn't consider a property that was under $1 million. Um, when Jim Shreve, that engineer we were talking about, decided to found Cost Segregation Services Inc., it was with the goal in mind to make it available to the small and medium-sized investors. And so our general rule of thumb is if the cost of the property, not including the land, is $200,000 or up, it's worth at least doing a cost segregation estimate on it. We can do a free estimate for anybody. And we can actually take properties that you've owned for even 10, 12, up to 15 years and go back and do a cost segregation study. And it's still well worth it financially.
Okay. Well, when you're talking about $1 million, I don't have any $1 million rental houses, but I have friends that have $1 million rental houses out in California.
Out
And
in
so,
California, you see them a lot.
yeah.
In fact, I just had somebody contact me. She's I had trouble believing this, but she's buying a $12 million house to rent. And before she could rent it, she had to put about $1 million worth of renovations into it.
Yeah. Yeah. That's a little hard for me to fathom.
Yeah,
um,
it's out of my league, but
well, I don't know how it would ever cash flow. What are you going to get in rent for something like that? $20,000 a month?
I
$50,000 a month? I don't know.
in Beverly Hills, maybe.
Yeah. Yeah. All right. So that's where cost segregation could kind of work. All right. So there is a way, if people will reach out to you, just look for Mr. Cashflow online, and that they can find out whether or not their properties might qualify. But it needs to be
Yes,
worth at least 200,000, not counting the value of the land.
I'll send them, especially if they text me. It makes it very easy. I will send them a list of about 5 pieces of information that I need to know about the property, and it's simple things like the address and the legal owner of the property and that sort of thing. To get them a free estimate. The estimate will show them exactly what the study will cost and the estimated tax benefit to them. And just know that when we do those estimates, we try to shoot about 10% low on the estimated tax benefit. Because I like calling people saying, yeah, we told you we were going to get you $40,000 off your taxes. We were off a little bit. It's actually going to be $52,000 off your taxes.
All right.
So,
I think that somebody listening to this might be thinking, I still don't have a grasp of what it is we're talking about. When you're doing a cost segregation, let's take you can pick an example, but let's take a small commercial building that's worth maybe $2 million. Let's take, like, I used to own a light manufacturing facility in
yeah,
Stockbridge, Georgia, and
okay.
it's worth $2 million. Give us just an example, for instance, on how cost segregation could benefit.
Sure. Well, we don't go by the current value. We go by the amount you paid for it when you bought it. So let's say you bought it for $2 million, not including the land, just to have
Okay, sure.
round figure.
I paid a lot less
Um,
than that for it, but yeah.
yeah. Well, or $1 million. If you bought a property, building worth $1 million, not including the land, basically what we're going to do is we're going to come in and we're going to look at that building, and probably let's say 20% of that is what they call personal property, not structural parts of the building. And that includes floor coverings, wall coverings, cabinets, countertops, window treatments, all of those things. So 20% of a million is 20,000, right?
Yeah. Now, is this a guess, or do you go in and quantify this?
No, we go in and quantify it, but
All right.
just for the sake of our
Okay. Yeah.
discussion, that's
Okay.
round figures.
All
So
right.
$20,000, um, we're going to get additional depreciation that very first year. So that's a $20,000 deduction from your taxes, basically, your income. Now, especially with residential rentals, um, this is a passive activity for most people. So the additional depreciation can only be taken from your passive income, which generally is going to be your rental income, unless you qualify as a real estate professional with the Internal Revenue Service. That's not easy to do. If you have a short term rental, it's not treated the same, it's treated as a business. And as long as you're materially involved in managing that short term rental, you can deduct it from your total income. And there are some other passive loss limitations that I won't get into here because it does get kind of technical in the
It's
taxes.
already getting kind of woolly.
Yeah, it does get taxed. And that's why people call me, because I can look at their property and walk them through. Here's all the options. Here's what it would mean for you. And I'll work directly with their CPA as well, because people feel pretty comfortable when their CPA says, yeah, this is a good deal for them. And so basically I'll send them the estimate. They can take it to their CPA, talk to them about it, or we can do a three-way Zoom call and I can
Okay.
explain it. The CPA
Did,
can call me.
did we get to a ballpark of what I'm going to save in taxes year one or year two?
It depends on your tax bracket. But if you can utilize all of that depreciation, $200,000 off of your, you know, off of your income
Yeah.
is what's taxed then. So you get that huge deduction.
Okay, that's what I was going to ask. If you get if the cost is more than you need to zero out your taxes, can you defer some of that to the following year?
Yes. If it creates a loss, that's carried forward to the next year and the next year and the next year
Okay.
until you use it all up. So you don't
So
lose any of it.
you buy an apartment building, you do a cost seg study, and then you don't pay any income tax the next year. And so what do you do next year? Buy another apartment building.
Exactly. Or pay down debt or whatever. And that's really what we were talking about, the time value of money. Because if you take the money that you make off of this and you put it to work for you, it becomes a whole lot more money. And I always kind of explained it to people, if I was going to give you $1 million, would you like me to give it to you in little pieces over the next 39
Yep.
years, or do you want it all today?
Yep.
That's the time value of money
Yeah.
because you put it to work, you know,
Yeah. My
most people who
listeners get
win the
that.
lottery take the cash option for that very reason.
Yeah, we've talked about that. My listeners get that. Okay, David, we're down to the last couple of minutes. We've got 120 seconds, and I'm going to blast you with 9 questions if we have time. You ready? All right.
I'm ready.
These are questions I ask a lot of the show guests. Number one, how does the general economy affect your business?
Well, it does. The real estate market affects my business, but the general economy, if taxes
Okay.
go up, my benefit is better.
Okay. All right. Number 2, when you were a kid, what did you want to be when you grew up?
When I was a kid, I wanted to be an astronaut.
All right. If you could have dinner with any person from history, who would it be?
It would be Jesus.
Okay. What role does creativity play in your business?
There's not a whole lot of creativity in my business because it's all facts and figures.
Okay. What are the business and economic trends you watch most closely?
I watch the Fed. I watch the stock market. I watch the inflation rate. Those kinds of things, and I
Okay.
watch the real estate market pretty close.
There's a lot of talk about pursuing your passion in entrepreneurial circles. Talk about the impact personal passion has had on your own life and business.
I started my company I started as a consultant back in 1989. When I formed my company, which is Cash Flow Strategies, it was with the whole idea of helping people make more money and keep more money of what they make. It's what I live and breathe every day. I love it.
Okay.
I just turned 66, never plan to retire.
All right. In your own personal goal setting and planning, how far ahead do you normally look?
The older I get, the shorter it is. But
My
I
dad
plan
says he quit buying green bananas.
yeah, I plan 1 in 5 years.
Okay. If someone walked into your life and said, I want to get into real estate investing, what are the first 3 things I need to do? What would you say?
I would say you need to talk to somebody who's really good at real estate investing, and I know a bunch of people, so I'll recommend them to you.
Okay. Number 9, understanding it is impossible to accommodate every person's lifestyle and spending habits with this answer. What would you say is the minimum amount of money a person needs in order to retire?
Wow. I say you probably need at least $1 million.
Okay. That's good. You have passed the round table. All right, everybody. This is Mr. Cashflow, David Wiener. You could find him anywhere on the internet if you'll just look for Mr. Cashflow and
Or
look up
Cashflow
cost
strategies.
Huh?
Or
Yeah.
cashflowstrategies.us.
Cashflowstrategies.us. Dave, thank you for being a great guest on the show today. We appreciate you very much.
My pleasure. Great to be with you.